All right, quick favor before we start. If you're watching markets right now, you need to hear this. Because something just happened in silver that almost never happens, and when it does, it's not random. In the last 24 hours, silver dropped roughly 21.5%, from about $120 an ounce to just under 97. That's over $1 trillion in notional value gone in a single day. Not a week, not a month, one day. And here's the part that should immediately grab your attention. Both futures positioning data and physical market pricing confirmed this wasn't a collapse in demand. It was a collapse in leverage. Stay with me because I'm going to show you what actually caused this, how to recognize it next time, and why moments like this often matter more after the crash than before it. Now, before I explain what triggered this move, let me slow this down and teach you something most people miss when markets go vertical and then implode. Price doesn't just move because people change their minds. A lot of the time, price moves because the plumbing underneath the market breaks. Think of leverage like stacking crates higher and higher on a shaky floor. It looks stable until it doesn't. When a market goes parabolic, like silver just did, that's usually leverage piling on leverage. Futures, options, margin. Everyone feels smart on the way up. But the higher the stack gets, the smaller the push it takes to knock the whole thing over. And when it tips, it's not orderly. It's forced. That's the key idea you need to hold on to here. The distinction between voluntary selling and forced selling is everything. Voluntary selling is emotional. Forced selling is mechanical. And mechanical moves create patterns you can learn to spot. If this is making sense so far, drop a comment below because I want to know if you've seen this pattern before in other assets. So what does that tell us? It tells us that when you see price acceleration followed by sudden collapse, you're not watching normal market behavior. You're watching a system under stress. And that stress doesn't show up randomly. It shows up when too many people are borrowing too much exposure with too little room for error. Now here's what's actually happening, step by step. Silver runs hard. Prices accelerate. Volatility expands. As that happens, traders aren't just buying silver, they're borrowing exposure to silver. They're using margin, which is basically a loan from their broker, to control more metal than they could afford to own outright. And here's the thing. Margin requirements stay relatively stable until suddenly they don't. When price reverses even a little, brokers raise margin requirements. That's the first domino. Now, traders who were perfectly fine yesterday are suddenly under-margined today. They have to sell. Not because they want to, because they have to. That selling pushes price lower, which triggers more margin calls, which forces more selling. That's the cascade. Futures liquidation feeds on itself. It's not a conspiracy. It's math. When everyone's borrowing and price moves against them, the system forces unwinding. And the unwinding doesn't care about your thesis or your conviction or your long-term view. It only cares about collateral. Here's where it gets interesting. This wasn't just one-sided futures pressure. We also saw options exposure getting crushed. When silver was trading above $100, call options were massively in the money. Dealers who sold those calls were hedging by buying futures. But when price collapsed, those calls went out of the money fast. Dealers didn't need the hedge anymore, so they sold futures. That's gamma unwind. It amplifies the move in both directions, up and down. And when you combine margin liquidation with gamma unwind, you get air pocket drops. Fast, violent, unsustainable. Now let me show you what very few people are talking about. The drop wasn't gradual. It was air pocket fast. That's a signature. When you see a 20% move compressed into hours, that's not long-term investors exiting. That's paper being unwound. And the confirmation matters. Physical silver premiums, especially in parts of Asia, didn't collapse alongside futures. In some cases, they stayed elevated. That divergence is a tell. Paper panic, physical patience. Futures traders were forced out. Physical buyers weren't panicking. They were watching. And in some cases, they were stepping in. That split tells you the selling wasn't driven by fundamentals. It was driven by structure. But here's the part that should make you nervous if you don't understand it. These events feel like the end while they're happening. Emotionally, they feel catastrophic. Mechanically, they're often transitional. The fear is real. The charts look broken. The headlines scream collapse. But zoom out and you start to see something different. You start to see that forced liquidations clear out weak hands and over-leveraged positions. And once that's done, price discovery can resume without the weight of all that borrowed exposure hanging over the market. This is the exact same playbook we've seen before. In 2008, precious metals got crushed during forced deleveraging, right before central banks stepped in aggressively. Gold dropped from over $1,000 to under $700 in a matter of months. Silver got hit even harder. Everyone thought it was over. Then what happened? Central banks launched unprecedented stimulus. Gold went on to make new highs. Silver eventually followed. In 2011, silver collapsed over 30% after a leverage blow off top. It hit nearly $50, then crashed back to 30. People called it a bubble, and you know what? It was. But it didn't die. It spent time building a base rather than going to zero. In March 2020, gold and silver both sold off sharply as margin calls hit everything at once. Stocks, bonds, commodities all liquidated together. Gold dropped from $16.50 to just over $14.50 in 2 weeks. Silver fell even harder. Then what? Within months, both were priced much higher. Every time this happens, the story sounds different. But the structure is the same. Excess leverage builds, volatility spikes, forced selling clears the board, then price discovery resumes. Zoom out and you see that these moments often happen near inflection points, not clean long-term tops. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could silver keep falling? Of course. Could this turn into something uglier if liquidity dries up further? Yes. Could we see $80 or even $70? Maybe. Markets don't owe anyone a bounce. And no, not every sharp decline is manipulation or some grand conspiracy. Look, I get it. When metals drop this hard, this fast, people want villains. They want someone to blame. But here's the thing. The market doesn't need villains when math does the job. Leverage unwinds on its own once the conditions are right. You don't need a shadowy cabal pulling strings. You just need too many people crowded into the same trade with borrowed money. And when that trade breaks, physics takes over. So could this be coordinated selling by large players? Maybe. Does it actually matter? Not really, because either way the mechanics are what matter. Focus on what you can control. You can't control forced liquidations. You can control your leverage, your time horizon, and your patience. There are probably 3 types of people watching this right now. The first group is panicking because you're overexposed and underprepared for volatility like this. Maybe you bought silver on margin near the top. Maybe you're holding leveraged positions that are now underwater. Maybe you're getting margin calls yourself. If that's you, let me be direct. The priority isn't being right, it's surviving. Reducing risk, reassessing position size, and protecting your ability to stay in the game matters more than catching a perfect bottom. Take the loss if you have to. Reduce your exposure. Get back to a position size that lets you sleep at night. Because if you blow up here, you won't be around for the recovery if and when it comes. The second group already sold or was forced out, and now you're staring at the screen wondering if you just made the worst decision possible. You're watching price stabilize and thinking, did I panic at the exact wrong time? Let me be honest with you. The selling already happened. Your job now is to wait for confirmation, not revenge trade. Don't chase it back up out of emotion. Don't try to prove you were right by jumping back in before you have a plan. Wait, watch, let the dust settle. If this was truly forced liquidation, price will tell you. You'll see stabilization. You'll see buyers stepping in. You'll see the structure change. But don't front-run that. The third group hasn't acted yet. You believe in the long-term thesis, but you're unsure what to do. Maybe you're holding physical. Maybe you're holding shares of miners. Maybe you're just watching and trying to decide if this is opportunity or disaster. For you, this is about aligning your position with your time frame. Short-term traders need signals, support levels, volume patterns, momentum confirmation. Long-term holders need conviction backed by fundamentals. Different tools, same discipline. If you're a long-term holder and the fundamentals haven't changed, then a 20% drop driven by forced selling shouldn't shake you out. But if you're trading, you need to see the structure repair before re-entering. Know which one you are. So here's what I want you to answer in the comments. Which group are you in? Are you holding? Are you out? Are you waiting? And more importantly, what's your plan from here? Because having a plan is what separates people who survive volatility from people who get destroyed by it. Here's where I stand. I'm not euphoric, and I'm not fearful. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone to see if price stabilizes instead of free falling. If silver can hold above 95 and start building a base, that would indicate the forced selling is exhausted. If it breaks below 95 with momentum, that would suggest there's more structural unwinding to come. Second, I'm watching volatility itself. Compression after expansion is how markets reset. Right now, volatility is still elevated. When it starts to compress, when the range tightens, that's when you know the system is stabilizing. Third, I'm monitoring physical premiums. If futures stay weak while physical demand stays firm, that matters. It tells you the selling pressure is concentrated in paper markets, not real demand destruction. And fourth, I'm watching how miners respond. If silver stabilizes but mining stocks keep falling, that's a red flag. If miners start to diverge positively, that's early confirmation that smart money sees value. Based on my analysis, this move was mechanical, not emotional. The fundamentals didn't change by 20% in a day. Central banks are still buying gold. Deficits are still massive. Inflation concerns are still present. Industrial demand for silver hasn't disappeared. What changed was the leverage structure. And when leverage unwinds, it creates temporary dislocations, not permanent revaluations. If history rhymes and silver finds support in the mid-90s and stabilizes over the next few sessions, the move that follows could be significant. Not because of hype. Because over-leveraged weak hands got flushed out, and the market can reprice without that weight. I'm not a financial advisor. This is not financial advice. Do your own research. Verify the data. Think critically. Don't take anyone's word for it, including mine. But if you made it this far, you're the type of person who wants to understand how markets actually work, not just get fed narratives. And that mentality will serve you well. If this breakdown helped you see the situation more clearly, share it with someone who needs to hear it. Subscribe if you want more real-time analysis when these moments happen. And remember, the best time to learn market structure is when it's being stress-tested in real time. Stay sharp out there, think critically, verify the data, and make decisions that let you stay in the game.